we could hit a turning point where you do get another explosive moment. And if I imagine how the end of this quote unquote cycle looks, I have to kind of look at the leveraged Bitcoin companies and say, well, maybe it kind of hits a little bit of temporary escape velocity, gets really frothy for a period of time. A lot of less well-managed companies enter the space, don't term their debt out very much. And of course, leverage is how you kind of blow something up that otherwise is pretty sound. And then we roll over and you get forced selling by some of the worst managed companies in the downturn. So that's kind of what I see on the horizon for a potential end of cycle catalyst.
A key theme in Alden's perspective is that Bitcoin is entering a new phase, one characterized by institutional and even sovereign-level adoption. As the daily issuance from block rewards becomes a smaller percentage of circulating supply, the price is increasingly driven by demand for existing coins rather than new issuance. In other words, price discovery is no longer about miners selling newly minted Bitcoin. It's about long-term holders deciding to sell or not based on price incentives.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
The short answer is I don't know, but the longer answer is I do think that our cycles will change in the sense that there's a couple reasons for that. One is I think partially, not entirely, but partially, I think the 4-year cycle was an illusion. The period of time from like Bitcoin, the lows of a cycle to the high of a cycle, that number actually changed pretty significantly in those cycles. Even though you kind of had one big peak per cycle, how long it took to reach that peak would vary quite a bit, and the direction you go along the way. And in the U.S. and kind of therefore globally, because of its global reserve currency status, the U.S. has historically gone through roughly 3-year liquidity cycles, and Bitcoin correlated with those pretty well also. So it was just kind of like this cadence somewhere between the halving and the U.S. liquidity cycle. I think those two things are both factoring into it. But now, as the asset has kind of reached the institutional and sovereign level, and as mining, new block rewards are a much smaller share of coins that people can buy. It's more about what price will unlock existing long-held coins. That matters more. I do think that overall the 4-year cycle, which is based on the mining block reward cycle, I do think that will keep diminishing. And I wouldn't really use that as a reference anymore. I would instead look at it in terms of hype or depression cycles, which are the types of metrics I just talked about. Are they elevated or are they very low? What does global liquidity look like? What maybe political catalysts have happened that might be good or be a headwind for the network? And is the current kind of valuation level appropriate given the broader environment around it? And that's how I would analyze it. Less focus on cycles, more focus on just, is this moment frothy or not? And my guess is that we'll see more prolonged but less explosive movements. Now, we could hit a turning point where you do get another explosive moment. And if I imagine how the end of this quote unquote cycle looks, I have to kind of look at the leveraged Bitcoin companies and say, well, maybe it kind of hits a little bit of a temporary escape velocity, gets really frothy for a period of time. A lot of less well-managed companies enter the space, don't term their debt out very much. And of course, leverage is how you kind of blow something up that otherwise is pretty sound. And then we roll over and you get forced selling by some of the worst managed companies in the downturn. So that's kind of what I see on the horizon for a potential end of cycle catalyst, but it's too early to say. And I would just treat every cycle as different. I held gold for years now. It's done better than the majority of investments. It's obviously not caught up with Bitcoin, but I didn't intend it to. I think there's a couple ways to look at it. One is the typical investor has liabilities or obligations. And so there's a certain volatility tolerance that they have, in addition to a psychological volatility tolerance. And so even if they're high conviction on something, they might not want a tail risk or a tail concern affecting 100% of their net worth. They want to be able to still function and meet all their obligations and liabilities and lifestyle services, regardless of what their biggest asset does. And so people will own other assets in many cases. The way that I've been looking at it is that gold is better than bonds for the low volatility side of a portfolio. And so in kind of quote unquote traditional finance, a 60-40 portfolio is very common. So people will have 60% equities, 40%, long duration treasuries, for example. And that worked really well for like a 40-year period where interest rates were structurally falling and they tended to be counter-cyclical to each other. But in an environment of fiscal dominance, bonds kind of suck. And so I've been writing to say, hey, if you own bonds, consider putting some or all of them into gold, or if you're going to own bonds, own shorter term ones. And that's been amazing advice. It's way better to own gold than to own like a 10-year, 20-year, 30-year treasury over the past many years. But when we look at, say, the other side, 60% equities, equities are historically a pretty good asset class, more volatile. And so my view is, hey, consider taking a slice of those and putting it into Bitcoin. And so I kind of just view, even though Bitcoin and gold are both kind of hard money that you can custody yourself, the maturity of the assets are very different. And so gold, I think, competes for lower volatility holdings, and Bitcoin competes for those with higher volatility tolerances. And there's no reason why you can't own both. You can say, well, for the higher volatility, I think Bitcoin's going to outperform, so I want to own a lot of Bitcoin. And for, say, a lower volatility area of my portfolio, or to sleep well at night, whatever the case may be, I want to, some gold on hand. And so I think they both make sense in a lot of portfolios. Not necessarily both for everyone, but certainly both kind of globally.
Alden closes with her favorite valuation tool, market cap to on-chain cost basis. This metric compares Bitcoin's total market value to the price at which coins last moved on-chain, often reflecting the average entry price of holders. Think of it like a real estate analogy. If only one house on a street sells at double its last price, all homeowners might claim their property is now worth twice as much.
If Bitcoin is going to become a multi-trillion-dollar asset, which it has, and I think it will continue to be, then there will be things built on top of it, and that's common. Any liquid asset is going to have that use case, and I think basically Bitcoin is like good for everyone in the sense that no matter what level you're operating at, if you become bullish on Bitcoin, the thing you're responsible for running should therefore probably buy Bitcoin. Like if as an individual, the first step is if you're bullish on Bitcoin, you get some Bitcoin. Second is if you're running a company, Bitcoin can benefit your company. If you've done the research and you've made a conviction view that Bitcoin is likely going to appreciate significantly, and you're the CEO or you're on the board or a treasurer, you have the responsibility to consider and then potentially allocate to Bitcoin. And same thing for ETFs and asset managers, and same thing for the sovereign level. If your job is to build sovereign level wealth for your country's government and you're bullish on Bitcoin, you have to say, hey, you probably should own some Bitcoin. And I think that we're seeing that play out. I think it's inevitable that as it reached this level, it would become more interesting to these large entities. When Bitcoin had $1 million of trading volume today, in a day, even billionaires couldn't really get in or out without meaningfully moving the price. It just wasn't at a scale that would interest them. You can talk about kind of 1,000,000% returns, but liquid returns matter. And so it's not like a billionaire could have allocated it at a meaningful way back in 2011. And when it hit a new level where there's billions of liquidity a day, well, now these trillion-dollar pools can at least start to look at it. And that's kind of what we're seeing. And so I think it's inevitable. And it's not Bitcoin changing for them. It's them choosing to change around Bitcoin. They're the ones, like the SEC decided to basically plug into Bitcoin. It's not that Bitcoin did anything to make the SEC accept it. And so that's what we're seeing. I think the Bitcoin base layer is still as good as it always has been, continues to gradually harden and improve over time. For price action, anytime you have leverage attached, you do have to monitor that. I mean, especially if you care about volatility and things like that. So it's certainly any sort of leveraged entities are worth watching. And I don't think I do think that at some of these really big conferences, you'll see like the main content is kind of corporate and sovereign. It's like Bitcoin companies and Bitcoin this and Bitcoin for politics. Whereas I do think it's important to keep emphasizing either the smaller stages at those conferences or other conferences or other online spaces to make sure that developers are getting funded, that privacy technologies are being supported, kind of the more cypherpunk aspects of this. And I don't think it's a zero-sum game. I think the corporate side can do well. And if anything, that gives more fuel for some of these other areas. But it is important to monitor these other areas to make sure they're not being neglected at the expense of some of the bigger entities. That happened to a lot of people in the dot-com bubble. It was like they were looking at the market in like 1998 and think this is pretty frothy, and then it's like, well, you haven't seen how high it's going to get. But I look at my favorite metric is market cap to on-chain cost basis. Basis, okay, what is Bitcoin market cap? That's easy to measure, price times supply. And then you look at on-chain cost basis, which is basically pricing every coin at the time it last moved on-chain. Which statistically mostly means the time it went to or from an exchange. Those are the biggest moments for that metric, and that creates kind of a psychologically important number. It's also basically it's kind of like volume adjusted market cap in a way, because and the analogy I use, if you have 20 houses on a street and none of them have sold in a few years, and one of them sells for double the price that it last sold at, you'll generally see that all the other homeowners mark up their real estate to the level that new one sold at, but that's the illiquid price. That's like 5% of those houses moved, and the whole street's now twice as valuable. But it's not clearly the case that if 10 of those were to sell, they would all sell at that higher price. And Bitcoin's obviously a much more liquid asset than that, but there's still a part of truth to that, which is if you get a really quick price move to a new level, if it does start to unlock a lot of existing supply, that price is not necessarily maintainable at that new high level in that window. But if it kind of reaches a price level and then spends 6 months or 12 months or 18 months chopping along at that level for a period of time, and the cost basis goes up and a lot of volume and a lot of liquidity has occurred at that new level, then that's a more meaningful liquid kind of price level for the asset. And so during prior multi-year peaks, we can call them bubbles, I suppose, because you kind of had a few years of a bear market afterward, they hit very high levels by that metric. Currently, we've not hit anywhere near the levels that are historically associated with multi-year drawdowns.
Alden also makes an important point about ensuring that Bitcoin's original ethos isn't lost as institutions enter. While she supports corporate and sovereign adoption, she stresses the importance of funding developers, privacy tech, and decentralized infrastructure. The cypherpunk movement gave birth to Bitcoin, and its values, freedom, privacy, self-custody, should not be neglected in the pursuit of mass adoption. Please like and subscribe.